Well, I wanted to talk a little bit today about, now that we've sort of hopefully gotten through the major crisis part of the crisis, where exactly we are going in your markets and how your investors are reacting to it, and how are you as an institution reacting to that?
Sure. I mean, we've the Middle Eastern market, which is where we focus on, after they've taken as big of a hit in 2008 as other global and emerging markets. And while other emerging markets had a significant rally, the MENA markets did not have as much of a rally. And it's interesting, you see, if you look at the Greek market, for example, and you look at the Saudi market, you can see more resemblance with that, while Saudi has the lowest debt to GDP in the world. So basically, the MENA markets did not have as much of a recovery as the rest of the world had, while the macro picture is very solid, and the countries and economies are very fortunate in many ways. Now that had resulted in a decreased level of interest from some of the global investors who were very highly interested in the markets prior to 2008. If you look at the European
due to the volatility, or due just to the severe nature of the drop, or both?
It's mainly because of the disappointment that the markets did not have that the markets, there was an expectation that the market is more insulated than the rest of the world, and this did not reflect.
Correct.
And then when the recovery happened, it also didn't reflect. So there's a kind of lost level of interest in general from certain pockets. Now you're starting to see other, pockets who see this as an opportunity, because it just, there is a disconnect between the fundamentals and what's going on in the market. And particularly, if you look at the U.S. and some of the most reputable U.S. endowments, they're seeing that there's this disconnect, and they're looking at the market to potentially allocate to. I mean, some have already started to allocate, and others are in the process.
And is there sufficient liquidity in that market in terms of volumes traded and turnover to actually take large investments from outside, professional investments in endowments, for example?
Well, yeah, I mean, the liquidity have dropped substantially from levels that used to be north of $10 billion to now around $10 billion, depending on the days. But still, with $1 billion, there is reasonable liquidity to be able to take. And realistically, I mean, these endowments will be allocating very small proportion of their overall portfolio and gradually build up. So. There, definitely for certain companies and certain markets and certain stocks, there's definitely sufficient liquidity.
And are there certain sectors you're preferring right now versus other sectors in your markets?
Sarah, there are a number of manufacturing companies that will be significant beneficiary of the major infrastructure spending that's taking place in Saudi Arabia particularly, where they've been depressed quite significantly during the last couple of years, and we see huge opportunities in a number of those companies. We also like some financial institutions, and then petrochemical companies have a natural comparative advantage on a global basis, and some mineral companies which also enjoy such a significant advantage. And then lastly, a number of companies that are beneficiary of the demographics and the retail opportunity in these markets, which, interestingly, I mean, recently A.T. Kearney had done a study globally to see which are the most attractive markets from a retail perspective, and realized and they've listed the top 10 markets, which included the BRICS, the 4 BRICS, but also included Saudi, Kuwait, UAE. So,
which makes logical sense given how young your demographic is anymore, and also much more highly educated than before. So I think the two reasonably go hand in hand usually with retail.
Definitely.
As we say, retail therapy in America, and such. So what would you say is the largest risk you would be experiencing investing in the markets now?
Realistically, and it's very unfortunate, but the reality is the global market is our largest risk for this market, and it's unfortunately
the correlation.
The correlation since the crisis have shot up significantly. It dropped a bit, but then it caught up again. And what happened is there's been a number of shocks in the system. First, you had 2006 crash, then 2008. And after that, there was the Ma'an Sana and Gusaybi issue, and then Dubai came through, and then Greece. And so at the time when beginning 2010, local investor confidence started to come back again gradually. Then the Greek story blew up, and that shattered that confidence again. So realistically, I think the global, if there's any
stability of the global markets will have a large impact.
Definitely, and so I mean, there's a reasonable level of stability with no shocks. Then I think there's very good potential for the confidence of the Saudi investor to come back. And if you look at the Saudi investor, they've moved out of the stock market. They effectively have two options to invest in, either the stock market or the real estate. And they've moved into the real estate, and now real estate is a bit toppish in certain segments, at least in Saudi. So it's a natural transition for them to go back to the stock market, given that as long as there is a certain level of stability.
Final question: bull or bear, Middle East markets?
Listen, I'm very bullish from a long-term perspective. I think I also recognize that if there are shocks in the global system, that the markets will be impacted, and that's why it's good to keep a small part of cash to take advantage potentially of these situations. But I'm very, very bullish in the medium to long term.
Great. Thank you very much.
Thank you, Sarah.